Hey, good morning, everyone. Marty Mazzora here. Thursday, the 15th of February, 2024. End of week market snapshot. Client should get it tomorrow morning. Link to an email as your Friday morning message. I'll keep it relatively short today. I do want to touch on the economy, specifically the prospects for stagflation. I mentioned it in the last video as a distinct possibility going forward. And this morning's data releases inspired me to talk about it on the written blog. Want to look at sentiment briefly, and then look at the usual charts, the ones that we've been looking at week after week here for quite the number of weeks here of late. So to start with the economy, I mentioned the prospects, or that there are prospects for stagflation going forward in this economy. Well, this morning, retail sales numbers came out for January, and this was the release. And as you can see, headline retail sales, okay, so that would be everything that's in that basket, actually declined on a month-on-month basis a very, very large 0.8%, which was above even the worst scenario among the economists, or the consensus of economists. The actual average consensus expectation was to come off the boil a little bit at 0.1. The prior month, which would be December, initially came in at 0.6. It got revised down as well. So not a good look for the consumer, and we've been flagging the potential for this going forward. Doesn't mean that this is the new trend. We actually think it probably is, but we're open to all possibilities. Take out cars and no revision. The consensus was that ex-automobiles retail sales would actually be up, and they were down 0.6%. And then take out gasoline and cars, and you had a minus 0.5%, and you expected actually retail sales to go up. Now, folks, you really got to also factor in that retail sales are delivered nominally, not on a real basis. So we're down that before inflation. So pretty ugly retail sales print for certain. It would make sense that bonds and things like gold, they're very interest rate sensitive things, would be rallying today, which they are. You also might think that stocks would be rallying. And actually, from a breadth standpoint, looks pretty good today. But what's not rallying is tech. And the S&P is only up 12 basis points right now. So anything like our core portfolio that has a good chunk of things that would play into this thesis, as well as inflation, is having a pretty good day relative to the market. So that's the weakening economy narrative. Now, I will say, as I noted here, there was bad weather in January, so there is that caveat that this may have been negatively impacted by weather. Now, as for inflation, we got import and export prices out today. Consensus was for a negative print, up a really big 0.8%. That's month on month, folks, so that's not small, right? Now, the prior year-on-year was still negative at 1.3%. Now, the prior was actually revised, positively, meaning last month the year-on-year was minus 1.6. It actually was revised to minus 2.4. But then we've got less of a decline on a year-on-year basis. And folks, it really is the month-on-month to look at if you want something that's not so impacted by base effects, right? Export prices, originally for December, down 0.9, revised to less of a decline, right? Exports down 0.7, but again, expected to come in negative, a big 0.8% positive. And in the prior year, on exports was a little worse than expected, meaning a little more inflationary or a little less deflationary at minus 2.9 versus minus 3.2, and then minus 2.4, which again, it's on a year-over-year basis. That's encouraging, but it's no doubt impacted by base effects from the year earlier. And I only brought that up because I was looking at this morning's data, and I thought, that's the definition of stagflation, right? That's a weakening economy as exhibited in retail sales, and rising inflation as exhibited in import and export prices. The other important release this morning was jobless claims. They were down a few thousand. I didn't pull up that chart, but it was better than the previous week. And there is unequivocally still a labor hoarding element in this economy. Companies had a devil of a time getting people back to work, and it's still the number one concern in the small business survey is we can't find anybody who qualifies who want to work right here. That's changing. The quits rate is going down and so forth. So, people are going to want to work, but the problem is if the economy is slowing, as we're seeing in the job openings number, their opportunities are going to be less. But they had such a hard time finding good quality workers that they're going to be reticent to let them go right here if they can hold on to them. Now, that's not the narrative we're hearing from the tech space, right? It seems like every day today it was Cisco Systems laying off 5% of their global workforce, which is like 4,000 folks, 4,000 or 5,000 folks, and that's not small. Now, I have a criticism, I guess it sounds like, and I think it is, particularly tech sector CEOs. Folks, I'm sorry to say that it is all about their stock prices. They have become, as one of my favorite macro analysts says, stewards of their stock prices. That's pretty much their job. That's what their bonuses are based on and everything else. So the minute they see stress, labor's real easy to let go if you can, or it's really effective at juicing your quarterly earnings reports going forward. That's why we look at cash flow. That's why we look at valuations. We respect price to revenue or price to sales more than we do price to earnings to really get a feel for how a company's doing. Because, it's hard to manipulate revenue. It's easy to manipulate or to make changes near term in an effort to keep your stock price buoyed that will essentially show up in the earnings. But if revenue is going down, revenue is going down, right? So, and by the way, folks, the price to sales ratio is way, way, way out over its skis. It's comparable, a little less than 1999, but that's the only other time that you can find them this high. So that's a few of the things that concern us about the overall equity market setup. Now, speaking of the equity market setup, I think I said last time there's a reason why people who trade sentiment do so with such high conviction. It's because it tends to work, right? But timing is everything, of course, if you're a short-term sentiment trader, if you will. And that means typically a sentiment trader is someone who looks for it to get all bulled up or bared up and to the extreme. And then if they're all bulled up, they will go short. Meaning that you just get a little bad news and everybody's on the bull side of the boat like they were heading into 2022, which was a mess, right? You can see the chart here. Now, and when everybody is all bared up, everybody's just scared out of their minds and on the bear side of the boat, little bit of positive move, they succumb to FOMO, fear of missing out, and they buy, and then there's your 2023 chart. Well, coming into 2024, this is up to date as of this week, bulls have come off the boil a little bit with a little bit of corrective action. Still a massive spread between the bull and bear sentiment, but a little bit less. And we were, epically bullish, right, at the start of this year. But this year just continues to melt higher. A lot of momentum. So, more fear of missing out is, particularly among professionals, they have a tough time mentally disputing these narratives when they're watching returns run away from them. We do not, thankfully for you clients, we do not succumb to such impulses. Our job is to be good stewards of our clients' long-term money, and that means have a process that gives you an accurate view of risk-reward setups and allocate accordingly. So anyway, so you have this, and you can see this bullishness is lasted a little longer. Now, it's not that it rolls over right away, right? A lot of times you do get this kind of action before the market rolls over if it's going to, but this market has been holding up pretty nicely. Confirmation of that rampant bullishness shows up in the investment advisor sentiment. This one is so good as an indicator of what to look out for. The bull-bear spread is plus 41.1. That's up from last week. Spreads above 40 point to elevated risk The wider the spread, the higher the risk. Plus 35 to 45, we're clearly there. Here's a chart, which is helpful, right? So here's the last time we peaked there and fell apart. Of course, we had a lot of choppiness right around this level. That was the July to October double-digit correction, right? And here we are again. The last time we were at these levels was back in 2021. And you can see while there was some choppiness back in here, we did sit above that level for quite some time before the market rolled over into what, for this chart, was a 27% decline in 2022. Remember, folks, we got short-term bullish right in here big time. In fact, that was right at our original bottom we called at 3,500, and we said that's where you'd want to buy. Back up in here is when we did that analysis, and literally that's where it bottomed. However, I said if our recession light is lit at that point, we're going to have to be very guarded because while we'll get a bounce off of that, if you have recession, corporate earnings, as I've illustrated a zillion times last year, will take the kind of hit, and valuations will have to take the kind of hit that, it could be that we hit this level again, could be that we go a little lower. We're in a position to be buyers of stocks, along the way, and we'll be careful how we do it, but we will be buyers of stocks in that scenario. But what this suggests is you don't want to be big buyers of stocks. I do think there are pockets of value out there, but you want to be very, very, very careful right here. Either conditions are going to have to improve to justify this, or stock prices are going to have to come down to where earnings, ultimately would be. If conditions as we see them right now, or where the risk of how this could play out actually, comes to fruition, so to speak. Okay, so the S&P 500 daily chart looks like a mess. You got to break down below this to get your outright sell signal as a short-term trader. This is a sell signal, by the way, on the MACD, and these are long, dangerous bearish divergences on the momentum indicators. As for the NASDAQ 100 index, or the ETF QQQ that tracks it, we did break down here. That would be your sell signal. It's trying like crazy to battle back. We're having a down day as I speak. We're in a rising wedge. Have your sell signal and so forth. This makes perfect sense. You got saved by the 20-day moving average. You're testing this level. You could definitely gap here yet to fill. You could definitely defeat these patterns right here. But right now, odds favor more weakness, and at this stage and where all the positioning is, if something breaks, it could be kind of ugly near term, so watch out. Now, the Russell 2000 small caps, I said we were notably more constructive. Not bullish as an investment firm that invests long-term money for folks. We want to let the next few weeks unfold and get a better feel for some other things that we've got our eyeballs on to determine whether or not we want to make that move. Still way off their all-time high, by the way. This is just a one-year chart. But remember, we had this real bullish pattern. I said that's a buy signal, and we got a whopping rally. That CPI print just took everything for a ride here a couple days ago. But look at that. Support right on the 50-day moving average. That would have been, I think, something, given this pattern, for a trader to perhaps buy. Then look what we're getting now. Like right now, small caps are up 1.37%, and the S&P is almost flat, and the NASDAQ 100 is actually down. So this is what you call rotation, folks. This is still, kind of a bullish narrative. This is like, okay, we still want to be in stocks, because the Fed's still going to save the day, and we got weak retail sales today. A weak dollar is not really a bullish thing for small caps. Small caps, because they're so domestic, tend to do actually better with the strong dollar. But nevertheless, this is just people, still believing in the stock market and rotating to what they believe looks like value to them. And I think that's fine, and I understand it. I just think this soft landing scenario, which this requires, is just a very dangerous narrative to glom onto at this juncture, but open to that possibility. Remember, we did say this was a bullish chart. We did say that looks like some interesting support, and here you go. But we do think that this chart could really break some hearts if indeed the economy in the U.S. continues to weaken. As for the signal from yields, definitely reacting to retail sales today. See how they've come down, although they've bounced back up a little bit, but still down. Not reacting to the inflation data from imports and exports. That bull flag just about played out, definitely coming off of that strong. As for the dollar, also reacting to the weak retail sales, not necessarily the inflation prints. This potential bull flag is not playing out. But notice, technically speaking, you also have traders and currency traders trade the technicals big time, right? And that is a key level of potential resistance. It's right where that big candle stopped here the other day and bounced, pogoed off that a little bit, upside down, so to speak. And here you are coming back right to this 104 support. If I were trading the dollar, I might be looking at swing trades right in here, and that might work for a little while between those two levels. This is going to be interesting. This is still a relatively bullish chart. You can see right here we're back down to this level, but that means these are bullish divergences, or close to it, at least on the RSI. And so folks, lots to look at. Very interesting market. It's what gets me up early in the morning and keeps me up late in the evenings with the Asian markets and what develops there. But lots to play out this year, folks. It's just fascinating to look at investors and traders chase these narratives around. We have to put on blinders, look a little deeper under the surface, and be objective. I think across the world there are massive pockets of value. I am more than a little excited about the prospects for the next cycle and the next bull market in assets. I think it's going to play out very differently than the last one did, but I think we're still in the very late stages of the existing cycle, and that gets really, really dicey. So thoughtful long-term investors need to be on their toes here. I think need to be hedged, and I think need to be uber diversified. And I think I'll stop there. Folks, thank you as always for watching and listening. Sometime over the next day or three, I'll get to the economic update and shoot you hopefully a quick video on that as well. Have a great day. Thanks again. Bye-bye.